Imagine your portfolio is a car on a long highway. Most days it cruises, but sometimes a sudden storm hits. A VIX ETF is like an airbag. It won't drive the car for you, but it can cushion the blow when markets slam the brakes. Stay with me until the end for a simple, step-by-step way to use VIX ETFs without blowing up your plan. First, what is the VIX? It's Wall Street's 30-day weather forecast for stock market turbulence, derived from S&P 500 option prices. When fear rises, VIX jumps. When things are calm, it sinks. You can't buy the VIX itself, only futures and options tied to it. So VIX ETFs and ETNs track indexes built from those futures. Here's the catch. Those funds rarely move one-for-one with the VIX, and many lose value over time. Why? Most hold short-term VIX futures and roll them day after day. When the futures curve is in Contango, think of paying more today to replace a soon-expiring umbrella with a pricier one next month. That roll cost creates steady, drip-drip decay. It's why buy and hold in these products is usually a bad idea. So how should you use them? 1. Think tactical hedge, not core holding. Use a small, time-boxed position to offset equity risk during specific windows, earning seasons you're nervous about, or when credit spreads widen and volatility wakes up. Size it modestly. Many disciplined investors cap any single VIX ETP to 1 to 2% of portfolio value. 2. Match the tool to the job. Long VIX ETPs can spike when markets drop, acting like a temporary airbag. Inverse products, such as those targeting minus 0.5x of short-term VIX futures, can benefit when volatility drifts down, but they can be devastated in a sudden spike. In 2018, one popular inverse note was terminated after a single night of extreme volatility. Treat inverse volatility as advanced level gear. 3. Set exit rules before you enter. Consider a clear time limit, say 5 to 10 trading days, or a target like trimming after a 20 to 40% pop. Equally important, a maximum loss, for example, cutting at minus 15%. Write the rules, follow them. 4. Avoid layering risks. These funds can be volatile enough. Don't add margin and don't combine them with other leveraged bets. Keep the rest of your portfolio boring. Diversified equities, high-quality bonds, and cash. 5. Consider simpler hedges first. Sometimes the best volatility trade is lowering stock exposure, adding cash, or buying a small S&P 500 put spread with a defined cost and payoff. Concrete example. Suppose your €50,000 equity portfolio feels exposed before a major policy announcement. You buy €750 of a long short-term VIX ETF, about 1.5% of the portfolio, with a 2-week time limit, a minus 15% stop, and a plan to take profits in thirds if it rallies 20, 35, and 50%. If volatility fades, you exit by your deadline and move on. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. Final thought, VIX ETFs are power tools. In steady hands, they can help. Left running on the workbench, they can do damage. Use them with intent, small size, and strict rules.